On the heels of a strong 2023, the market has continued to surprise to the upside, with the S&P 500, the Dow Jones Industrial Average, and the Nasdaq all notching record highs in 2024. So, is it time for a pullback? We think so. The S&P 500 and the Nasdaq 100 are each up nearly 10% year to date. This is an amazing return, especially in 3 months. If we were to annualize this number, the market would be up more than 40% for the year. Historically, it's not an unprecedented number, but in this environment, we don't think returns at this level are sustainable. The S&P 500 has made it to 102 consecutive trading days without a 2% correction. Plus, the S&P 500 has posted a weekly gain in 16 out of the last 18 weeks if we go back to the last week in October of 2023 through March 1st. If you look at when the S&P posted gains 16 out of the last 18 weeks, it hasn't happened since 1971, more than 50 years, and going back for the last 70 years, it's only happened 5 times. Near term, we would not be surprised to see a correction of 5 to 10%. That would not be unusual, as the S&P 500 historically pulls back 5% about 3 times a year and 10% about once a year when looking at the declines from 1953 through the end of 2022. With all that said, we believe we are in a secular bull market and any pullback will be short-lived.
So what's been driving the market this year? Last year it was all about inflation and interest rates. This year it's all about earnings and the economy. The market's finally back to trading on fundamentals, which is good. This is why equities have been resilient despite the rise in Treasury yields. We'll cover all 4 of these important market drivers: inflation, interest rates, the economy, and earnings, in this market commentary. Looking at the broader economy, the Fed's last statement sums up the trend nicely. According to Powell, the recent indicators suggest that the economic activity has been expanding at a solid pace. Job gains have remained strong, and unemployment rate has remained low. Inflation has eased over the past year but remains elevated. Forecasts for real GDP growth in 2024 rose from 2.1% from 1.4% in December. With the outlook for stronger growth, the Fed's unemployment rate expectation shifted down to 4% from 4.1%. And this week's release of February's durable goods orders, which essentially measures business investment in expensive items used to produce output, it was up 1.4% after a 6.9% drop in January. Much of this is led by the surge in orders of commercial aircraft and autos. This is just one data point, though, that shows that corporate America may be getting comfortable with the economy and more willing to invest in their supply chain. Also noteworthy, the labor market has remained strong. Initial jobless claims last week fell to 210,000, which is a very low level and a strong sign of strength in the economy.
Core inflation expectations, which excludes energy and food sectors, rose to 2.6% from 2.4%, but continue on a downward trajectory. Estimates for core PCE, the Fed's preferred inflation metric, out to 2026 continue on their disinflationary trend, going from 2.6 in 2024 to 2.2 in 2025 to 2% in 2026. If the economy stays strong and inflation sticky, the Fed may push its projected June rate cut to July, and it also may lower the number of targeted rate cuts in 2024 from 3 to 2. It may seem counterintuitive, but we do not view this potential outcome as negative. If this occurs, then it means the Fed believes the economy is strong enough to withstand a slower path to their neutral rate of 2.6%, which is good. With that said, the Fed remains flexible and data dependent to avoid being pinned down by a hypersensitive market overreacting to volatile monthly data. This provides some downside risk management for the economy. We are listening to and watching the Fed, but we're not obsessing over it. We are focused on other important matters like business investment, innovation, think AI, and corporate profits. In the end, it's these factors that can drive the stock market valuations the most.
This was a good earnings season, and analysts are now estimating that the average growth rate for the S&P 500 earnings will be expanding at 10% on a year-over-year basis. Earnings estimates continue to rise, and this barometer of the market is the most correlated to the direction of stock prices. Profit margins appear to have now troughed and are actually expanding despite a higher inflation and interest rate environment. This economy is more service-based than manufacturing-driven, and demand appears to be more elastic or more flexible in this higher interest rate environment. Even as higher valuations pose headwinds, markets have been driven by price momentum and the generative AI cloud transition-led earnings upgrades, which have been embraced by the market. As always, we're selective in the companies we own. As a point of reference, the best performing stock last year was a tech stock, and the worst performing stock last year was also a tech stock. So selectivity is critical. As we look out for the remainder of the year, we think economic data could remain choppy month over month, but the long-term trajectory and trend is what we focus on. We view market pullbacks, which inevitably will occur, as buying opportunities in this market.
If you joined us for our January webinar with Liz Ann Saunders, Managing Director and Chief Investment Strategist for Charles Schwab, we think that she said it best.
Neither get in nor get out, especially if it's sort of all or nothing. I want to, put all my money in or take it all out. Neither get in or get out is an investing strategy. All that is gambling. And it's gambling not just on a moment in time, it's gambling on 2 moments in time. And no one, not a single solitary person, can do that consistently well. I don't know any successful investor that got there by all or nothing, get in, get out approach. Investing has always been, should always be a disciplined process over time. Never, ever about a moment in time. And therefore, it's not what I know, or Lizzie, or some Yahoo on whatever network knows, meaning what's the market going to do? What's year-end price target nonsense? Or I think the next 10% correction is going to start 3.5 weeks from now at 2 p.m. on a Tuesday. It's not what we know that matters. It's what we do that matters.
As always, thank you for the trust that you place in our team. It is a responsibility that we do not take lightly. We are excited about the quarterly webinars we have planned for the remainder of the year. Please be on the lookout for an invitation to our upcoming webinar covering the topics of behavioral finance, estate planning, and a Washington update as we near the election. If you have any questions or if there is anything that we can be doing for you, please reach out to our team.